Okay, good afternoon, everybody. Welcome to the February edition of Market Insights. Good afternoon, Rich. Good afternoon, Gavin.
Hey, Todd.
Hi, Todd.
How's everyone doing as we, get into the middle of winter here? It's been a tough go for us, not for you, Rich, but for Gavin and me. In the cold Northeast and Midwest, it's been tough, but there seems to be some positive signs down the road that winter may be coming to an end. Before we jump in, let's hear from the Legal and Compliance Division. Okay. Well, let's kick it off as usual and start with the recap of our January meeting. A lot of things have gone on since January. We'll touch upon, but why don't Rich or Gavin give us just a brief breakdown of the January meeting?
Well, really, to start the year, we've talked about a weaker U.S. dollar. And if we look at that, we can kind of point to across the asset classes, stocks, bonds, other currencies, and commodities. We can find links between a weaker dollar and what we've seen unfold so far this year. So we wrote about that to start the year. And again in February. And so I think that's remains, the same, and that weaker dollar is mostly a tailwind for many of the markets doing well so far this year. And that's basically it. It's kind of just watching this unfold and seeing the impact that's having. And then I think, Rich, you're probably going to get into some different things, but one would be maybe growth assumptions. Todd, I know we've talked about this, remaining as we go through the year, what that looks like compared to consensus. So maybe we want to hit on that too.
Yeah, I would just add that aside from our signals, which continue to reiterate the dollar is bearish, that's a tailwind for international equities over domestic. It's a tailwind for gold over bonds. It's also supported by the fundamental view, I think we touched on last time, just this massive net international investment position that says foreigners own 26 trillion more of US assets than Americans own in foreign assets. And, weak dollar is going to incentivize them to bring capital back to their local market. So we think that the weak dollar theme, has some staying power. There was a bit of disruption with the announcement that Kevin Warsh is going to be the next Fed chair. And I don't know that is really going to change the weak dollar outlook. If we had to speculate, like what was a conversation between Trump and Bessent and Warsh that got him the job, I think that major bank deregulation is probably part of it. We know that Warsh is a hawk on the balance sheet, and for good reason. Powell was running QE when inflation was 8%. Of the 6 trillion of deficit spending in 2020 and 2021, Powell monetized 60% of that. So it almost appears, and this is just speculation, but it almost appears that, okay, if you want to get the Fed's balance sheet down to a more reasonable level, then what do we do to offset the tightening that would otherwise cause? And Bessent has been a champion of, bank deregulation. I'm thinking of the, 900-page Dodd-Frank bill that nobody read, but it passed. There's plenty of low-hanging fruit, to deregulate banks. And that would be consistent with broadening out of performance to include industrial, cyclical, small caps, which we're seeing, and which part of that adds up to, a long-term growth outlook where consensus on growth, is too low. part of that ties in with productivity, where we're seeing, sizable gains in productivity. And if we can get productivity to run at 3 or 4% instead of 1 to 2%, that directly translates into better corporate profits. Corporate profits translates into good stock market performance. And the consensus estimates on long-term growth are still stuck around 2%. And that's the old, the pre-COVID trend that doesn't account, for this productivity. So that's kind of a double-edged sword in that, we're currently seeing a jobless recovery. If you look at corporate profits, and this comes from the national income and product accounts. I'm not talking about S&P 500 earnings, but based on where corporate profits are year over year, you would expect non-farm payroll year over year to be about 2.2%, and it's at 0.5%. If you look at real equipment spending, it's running at 7.3%. That's normally associated with 2.1% non-farm payroll growth. And again, we're at 0.5%. And if you look at retained earnings year over year, that would imply a 2.1% non-farm payroll growth, and it's only 0.5. So productivity is good for corporate profits. It's good for asset owners. The jobless recovery is bad for people. And there's going to be a limit to that, before the pitchforks come out. That's kind of fourth turning dynamics, which we've addressed, previously. But, for the time being, we think there's going to be a tailwind for growth. Of course, there could be any number of disruptions along the way, but, for the next couple of years, I think growth is likely to surprise to the upside.
Well, let's stay on that growth theme, because we've been kind of calling for higher than expected growth or higher than reported growth. And what sectors and what asset classes, and we're kind of in quad one, maybe drifting towards quad two, which is typically good for markets, equity markets at least, I should say. With these higher growth expectations or higher growth expectations that we see, how are we positioning? What should clients be looking to that you think might perform well in that environment?
Well, quad one and quad two are both risk on. So, our of our various strategies, we're at, kind of our full equity allocation. Then vary strategy to strategy, but you get paid to take risk in quad one and two. Quad two took over between, last time we got together, it was quad one in the lead. In the last month, that's moved over to quad two. In quad two, you get dispersion. Quad one, everything tends to go up. Quad two, you get dispersion where certain things don't like, the upward pressure on inflation or interest rates. So it pays to be a little more selective, but, we are sticking with, overweighting international relative to domestic. And then within domestic, we're seeing a broadening, kind of a rotation underway from like the AI pure plays to the AI beneficiaries. That ties back to, productivity. So we could see an environment where, companies like anecdotally, Dow Inc. Announced recently that they're laying off something like 13% of 24,000 employees. Is going to save them $2 billion. A lot of that is AI driven. So on one hand, that's good for shareholders of Dow Inc. It's bad for the workers that get laid off because most other companies are going to be looking to do the same thing. How do we save on labor? How do we get the same amount done with less headcount? That shows up in productivity, which is good for, stockholders. It's not necessarily good for the labor force. So, we could see a continuing broadening out where the transition goes from, who's building the AI infrastructure to who utilize it, to reduce costs and boost profits.
Yeah, but do you have anything to add to that? That's a that's a lot. This AI conversation, I think, is going to be a front and center topic for us for the foreseeable future, whether it's, companies that directly or indirectly are going to benefit from AI. And I think your depiction there was good, Rich. Gavin, what do you have to add to that? Anything to add to that?
Just the same points as Rich, maybe just going back to it was either market insights in the fourth quarter of 25 or maybe our core stock note. One of them, though, I know that when the S&P 500 equities kind of had a little bit of turbulence back in the fourth quarter, we wrote about, and what was being talked about then was this AI growth narrative, because so much of the growth last year, especially at certain times, came from that sector, that small piece of the market. And I think we wrote something along the lines of, we will have to see if the market can broaden and have more participation. And that's exactly what we got. We ended up getting, like Rich just said, in the beginning of a growth accelerating type boom, if you will, you would imagine cyclicals value, but we also got international, which tend to have a lot of value factor in those companies. If you look at the top companies in Europe, for instance, they don't have all the big tech companies like we do. They have energy companies, they have financial
banks, insurance, sure.
Yeah, so I think what Rich was highlighting is accurate. It's just we got this breadth widening out of the just the pure AI trade, and I think his point on productivity is very interesting. It's an interesting way to frame it.
Well, I agree, and more breadth in the market is always good. You need to get participants from other areas other than the Mag 7 and technology. So I think overall that's a positive to see some contributions from some other areas of the market. Well, I think that concludes our February market insights. Anything else to add before we sign off here? Or
they did.
Okay,
that'll do it.
Todd, they didn't call you for the Fed chair. I thought you're looking good today with the suit.
I came in second.
You came in
second.
Okay.
I came in second. So.
Yeah.
All right, guys. Have a great rest of February, and we'll huddle up in March.
All right.
All right, sounds good. Take care.
Thanks. I lost my background.